Hello everyone, it's been a minute since we last made a YouTube video. However, we couldn't resist but covering what Christine Lagarde, the head of the ECB, the European Central Bank, had to say in her speech to the People's Bank of China. Another central bank, or a central banker, the head of a central bank I should say, is signalling to us what's about to happen with our monetary system, and a major change is coming. And whether you're into crypto or not, this is going to directly impact you and your life. If you use money in any shape or form, if you get paid in it, if you store it, whatever it may be, this is going to directly impact you. And by this I mean what's coming. And what's coming is a change in the monetary system in which there are going to be winners and losers. And what I'm going to do is look at the dollar and its kind of role in all of this, and how we're about to see a kind of another Bretton Woods, which Jerome Powell had previously mentioned in his speech. One of the last videos we did, we covered that, and how we, or the central bankers and the kind of bankers more broadly, are all signaling that this is coming. But Christine Lagarde very much confirmed this in her speech to the People's Bank of China. I think it was on the 11th of June, which was just a couple of days ago. And I want to share that with you, again, because this is just so important. Whether you're into crypto or not, this is directly going to impact you, and you might as well benefit from it, not stand to lose in regards to the change that is about to take place. And there's things like silver that are signaling a very similar thing to what took place in Bretton Woods, with a move that we're expecting for it. Gold and its breakout is relevant to all of this. The dollar and what it's currently doing, and we're going to look at it through the lens of the DXY, which is the dollar currency index. It's about 40% against the euro. Euro looking like it's going to break to the upside against the dollar in a major move. And the interesting thing is crypto's positioning of all of this. It was given to us in 2008 when the kind of cracks in the system really started to show. And since then, the monetary system has been on a trajectory of change, and we're at a point where that is about to take place. And I think, again, gold and its move has everything to do with this. The move that's going to take place for silver has everything to do with this. Silver did a very similar thing on the back end of the Nixon shock in 1971. And it couldn't be a more interesting time, despite the lackluster price action in the cryptocurrency space, to be a partaker in it. Because it's my belief, and you guys all know this, that when there's too many coincidences, perhaps it's not a coincidence, and that this technology was given to us to essentially usher in this new system that we're on the cusp of. What I want to do very quickly is recap on what Jerome Powell had to say. In one of the last speeches that he gave, he brings up Bretton Woods and relates it to where we are today. Now, why is he doing that? And that's a kind of signaling, I think, if you will, or an alibi, if you will, in regards to if it happens, you can kind of say, okay, well, we did talk about this. Just like Jamie Dimon talking about, you are going to see cracks in the bond market, which is currently how our financial system works. And if you look at the comparables there with Bretton Woods, you had the asset that backed the financial system up until the Nixon shock being gold. There was issues with that, and they had essentially given out more dollars than they had gold to back it. Of course, France was the first person to ask for their gold back, and it caused essentially that shock. And then we all kind of agreed through the avoidance of mutually assured destruction to accept the system that we have today, which is a fiat system, which is debt-based. And anybody who's everybody, even if you're into finance or not, you're into crypto or not, you'll know that there's an issue with the debt system. And you'll know that perhaps even indirectly through understanding what's going on with prices, whether it be housing, whether it be, you know, food prices or whatever it may be. It's all related to the monetary system, which is ultimately the sole causer of inflation. So let's recap on what Jerome Powell had to say. Then what we're going to do is take a look at what Christine Lagarde also said just the other day at the People's Bank of China. She also mentions Bretton Woods and where we currently are and this kind of change that is going to take place. And in Bretton Woods, what you saw was a devaluation of the dollar by about 1/3. I think you could see a similar thing. And I think this is why gold's already started to run. It's almost a canary in the gold mine, if you will. I think silver's going to just under 10x from where it currently is, potentially go higher, and I'll show you all of this. And I think Bitcoin's going to do extremely well, and has been positioned to do well by the likes of Larry Fink, who of course is the head of BlackRock, and many other people out there. Isn't it interesting that there's been this kind of shift towards the cryptocurrency space, whether it's regulatory, whether it's financially, all at this kind of time in which the debt system just simply seems to be losing control. And now you have all these central bankers essentially coming out and saying, you know, we're in a similar period to what led to Bretton Woods 2, which was, of course, the Nixon shock. So let's go ahead and play this clip of Jerome Powell just as a recap. Then we're going to show you what Christine Lagarde had to say, and then we'll link assets like gold, silver, and of course Bitcoin into all this. So let's dive into that.
Emerged from World War II as a global economic superpower. The Bretton Woods Agreement placed the U.S. and the Fed in a central position in the global economy. Our mission then, as it is now, was to serve the American people. But it was clear at that moment that the Fed needed to have better knowledge of global developments to achieve our dual mandate goals. A 1948 memo proposing to create the division stated, quoting, "Problems of international economics and finance have become increasingly large, complex, and significant in recent years, and our foreign economic relations will undoubtedly continue to give rise to issues of the first magnitude." That rare economic forecast that has turned out to be spot on. 75 years later, it remains critical that the Fed understand the policies and practices of other governments and central banks and their implications for the U.S. economy and for financial markets. Exchange rate policy, of course, is now firmly in the hands of the U.S. Treasury. However, the end of the Bretton Woods era in the 1970s fundamentally changed the conduct of monetary policy, as policymakers had to understand the effects of potentially more volatile movements of the U.S. dollar on American families and businesses. Understanding global trade and capital movements has only grown in importance since 1950, as we saw during the pandemic.
And we highlighted the interesting nature of Jerome Powell talking about Bretton Woods and comparing the kind of lead up to that in regards to where we are today and their need to be attentive to similar issues. And I think all of this, the reason they're all coming out and saying this is very obvious. It's obviously what's happening with the bond market, which is a thing that backs the very monetary system that we have today. But they're all coming out and saying this because something ultimately broke with COVID. You know, it was kind of the straw that broke the camel's back, if you will. But really, the breaking or the realization of the broken system, I think, came in 2008. And of course, what subsequently was given to us on Halloween 2008? Well, it was Bitcoin, which has done remarkably well and been remarkably right since then. The broader innovation, you know, not the new financial system isn't going to run on top of Bitcoin's distributed ledger. It's not how this is going to work. It's feasibly not possible for that to be the case. In my own personal opinion, I'm sure some people would argue with me on that. I think the broader innovation is with DLTs, and I think there's certain DLTs out there that are going to essentially enable this new global, one world financial system in which we are moving towards. And that is what's going to come on the back end of what all these central bankers, all these bankers are essentially signaling, which is issues that essentially are a problem. There's going to be a reaction, which we're starting to see now, and then a solution. The reaction could be many things, but one thing is certainly what's happening with gold, which is running away in a similar manner to what it did post the first Bretton Woods Agreement, or the second Bretton Woods Agreement, obviously being in 1971. So the reason I make this video, because we kind of covered this, perhaps not with all this information, but in a roundabout way. We kind of covered this the other day where we looked at specifically what Jerome Powell was saying. The reason I make this video is because of what Christine Lagarde, another central bank, as one of the heads of the major central banks, had to say to the People's Bank of China in her speech. This is a tweet from her directly. In a fragmented world, regions need to work together to sustain global trade, a driver of prosperity. Today's geopolitical landscape makes this harder, but by learning from the past, and she'll specifically mention Bretton Woods, we all can draw a new map of global cooperation. Let's dive over to her speech. Bearing in mind, the ECB has very much signalled this year their intent to use DLT technology. This is from the 20th of February 2025. Euro system expands initiative to settle DLT-based transactions in central bank money. Now, more recently than this, they'd released papers on a kind of wholesale CBDC. Obviously, they're working with Quant and a number of others out there. But this was also a paper from theirs on the 15th of May. It said, harnessing the digital future of payments, Europe's path to sovereignty and innovation. And it talks about a digital euro and the future of payments in Europe. Of course, they're talking about central bank digital currency here. The equivalent of this will be stable coins in America, more private money than public money, but they're very much one and the same thing. They're going to interoperate and essentially all work together in this kind of new financial system. And I think even in regards to the dollar isn't going away. It's just going to have a slightly different role, I think. And actually the more widespread agenda of the dollar, I think, could be quite fitted or could work better or be more easily enabled if it was cheaper, essentially. And a cheaper dollar ultimately could also mean an economic boom, which is why I think there's a major kind of bull coming for assets more broadly. Just to show you quickly, certainly silver, and this is on the back end of the first Nixon crash, you can see the kind of run that it had. And of course, silver, I believe, is going to, $350 plus. And I've had this prediction for a long time. This is on the cusp of breaking out of essentially a pattern that goes all the way back to 1979. And gold, we all know the story with. This is obviously back in the 1971 era, post-Nixon shock. It had a real run, obviously on the back end of the devaluation of the dollar. It's running like this again today. And this isn't the best gold chart that I have for you. I want to find you another gold chart, which of course I use, which has all our technical work on it that we've been doing for a long time now, and we're very, very right on. And I think gold is very much a canary in the gold mine in regards to what's coming. And what we have now is central bankers all over the world essentially signaling this. Gold's very close to our kind of ultimate target that we gave back in sort of 2021, 2022. All our targets have been met, and this is a canary in the gold mine, if ever I've seen one, telling you that something's going to break with the value system that is globally accepted, the world reserve currency and the financial system as we know it. And now we've got central bankers around the world all saying the same thing. Where Bitcoin fits into all this, we've obviously got over $300,000 price predictions for Bitcoin technically. I don't know how high it can go ultimately, but I do think that the kind of pivot towards it via Larry Fink and people like this couldn't be at a better time. And these people have a remarkable track record of being right and early on things, because ultimately they're in the know. They know the people that set policies and so on and so forth. So let's dive over to the actual speech, drawing a common map, sustaining global cooperation in a fragmented world. Speech by Christine Lagarde, president of the ECB, at the People's Bank of China in Beijing. Very interesting. And I don't want to read the first part, when she is essentially talking about the world and how we got here. I want to focus on tensions across history. And she starts by saying, if we look at the history of the international economic system over the past century, we can broadly divide it into three periods. In the first period, in the interwar years, major economies were tied together by the gold exchange standard, a regime of fixed exchange rates with currencies linked to gold either directly or indirectly. But unlike the pre-war era, when the United Kingdom played a dominant global role, there was no global hegemony, nor were there impactful international organisations to enforce rules or coordinate policies. Very interesting when you look at Britain actually no longer became that dominant force. It was obviously during World War II, and by the end of it we were largely bankrupt, and America had kind of at the end of that, obviously with the first Bretton Woods, sort of evolved into the role that it is today. Very interesting. Most people don't know when Britain kind of lost that status. It had been losing it perhaps leading into World War II, but certainly post had lost it, and was heavily actually indebted to America. And I think it was only in the 2000s we actually had fully paid our debt. I mean, that was one of the last payments we made on the back end of World War II into America. But quite a dangerous topic that we want to keep away from. So the system's flaws quickly became apparent. Exchange rates misalignment caused persistent tensions between surplus and deficit countries, yet the burden of the adjustment fell overwhelmingly on the deficit side. Facing outflows of gold, deficit countries were forced into harsh deflation. Meanwhile, surplus countries faced little pressure to reflate. By 1932, two surplus countries accounted for over 60% of the world's shared gold reserves. One-sided adjustments failed to resolve the underlying problem, and without strong alliances to contain tail risk, tensions escalated. Countries turned to trade measures in an attempt to reduce imbalances in the system. But protectionism offered no sustainable solution. In fact, if current account positions narrowed at all, it was only because of the fallout in world trade and output. The volume of global trade fell by around 1/4 between 1929 and 1933, with one study attributing nearly half of this fall to higher trade barriers. World output declined by almost 30% in this period. During the Second World War, leaders took the lesson to heart. They laid the groundworks for what became the Bretton Woods system in the early post-war era, a framework of fixed exchange rates and capital controls. Post-World War II is where you see the kind of rise of the start of the system that we have today. You see the rise of, I can't remember if it was the World Bank or the IMF, it was, a number of organisations came out of that all are still here today and still play significantly dominant roles, and are also all talking about the harnessing of DLT in regards to evolving a system. There's lots of comparables here, which is why I found this so interesting. This marked the beginning of the second period. The new regime was anchored by the US dollar's convertibility into gold, with the International Monetary Fund acting as a referee. Trades flourished during this era. Between 1950 and 1973, jumbling the words up there, or the letters, world trade expanded at an average rate of over 8% a year. Pretty impressive, certainly way more impressive than where we currently are today in a kind of low growth era. But again, frictions emerged. In particular, the United States had shifted from initially running balances of payment surpluses to persistent deficits. At the heart of this shift was the role of the US dollar as the world reserve currency and source of liquidity for global trade. It still is today, but it's just obviously backed by debt instead of gold. While US deficits provided the world with vital dollar liquidity, those very same deficits strained the dollar's gold convertibility. At US dollar 20 or 35 per ounce, so $35 per US ounce of gold, it threaded confidence in the system. By the late 60s, foreign holders of the US dollar amounted to almost $50 or 50 billion US dollars, were roughly 5 times the size of the US gold reserve. So they gave out more dollars than they had gold. And ultimately that's why we ended up with the Nixon shocks, which we're coming on to now. Ultimately, these tensions provided unsustainable as the United States was unwilling to sacrifice domestic policy goals, which generated fiscal deficits for its external commitments. The Bretton Woods system ended abruptly in 1971 when President Nixon unilaterally suspended the US dollar's convertibility into gold and imposed a 10% surcharge on imports. The goal behind the surcharge was to force the US trading partners to revalue their currencies across the dollar, or against the dollar, which was perceived as being overvalued. As in early periods, this was a one-sided adjustment, though now aimed at shifting the burden onto surplus countries. So, of course, to kind of have them accept this scam is potentially the right, but not perhaps the most fitting word here. They essentially said, okay, well, we'll devalue the dollar so that your currencies go up. They're potentially going to do the same thing with debt, or with the debt markets, and or they're going to do something with the debt markets, and how they're going to perhaps ease that passage is through devaluing the dollar massively so that countries kind of benefit from it, if you will, just like they kind of did with the devaluation of the dollar initially. It goes on to say, crucially, however, the downfall of Bretton Woods unfolded within the context of the Cold War. Countries operating under the system were not just trading partners, they were allies. And so everyone had strong geopolitical incentives to pick up the pieces and forge new cooperative agreements that could facilitate trade relations even in moments of pronounced volatility. We saw this several months after the Nixon shock, when Western countries negotiated the Smithsonian Agreement. This agreement was a temporary fix to maintain an international system of fixed exchange rates. It devalued the US dollar by over 12% against currencies of its major trading partners and removed President Nixon's surcharge. And we saw strong geopolitical initiatives at work again with the Plaza Accord in the 1980s, an era of floating exchange rates and free capital flows, when deficits and surplus countries in the Group of Five sat down to try and resolve tensions. Of course, neither agreements ultimately succeeded, in addressing the root cause of the tensions, but critically, the risk of a broadening or a broader turn towards protectionism, which was rising at several points, never materialized. The contrast is telling. Both in the intra-war and post-war eras revealed that one-sided adjustments cannot sustainably resolve economic friction, whether on the deficit or surplus side, yet the post-war system proved to be more resilient because the countries within it had deeper strategic responses to cooperate. So friction threaten global trade today. It talks about all the similarities of what led to changing the monetary system and the comparables in regards to where we currently are today. And I'm going to leave a link to this in the description because it's well worth reading the whole thing. And the reason really I bring this up is because why are they all talking about this now? Well, it's because of what's happening with our debt markets and the emperor kind of realizing that it has no clothes. Again, whether you're into crypto or not, if you use money, this is going to directly impact you. And I think one way to protect yourself or to benefit positively from this is to own assets outside of that value system being the fiat systems. It's the whole reason Bitcoin was created and has been remarkably right since its inception, leading a whole load of questions. And I think if we look at what certainly the Dixie is signaling, we for a long time now have expected assets to do well on the back end of the devaluation of the dollar post 2022. We get back into the markets at the start of 2023, January the 5th, 2023 to be exact, and assets have done very well since then. And we thought the dollar was going to come to the lower band of this channel. I can actually see it breaking out of this channel that it's been in, this upward channel that it's been in since 2008. And it's not just the Dixie. Of course, naturally, you would expect the euro US dollar to look similar. I think this is a major falling wedge. Again, it's been forming since 2008. That it's going to break to the upside of and retrace the entire move that's been formed since 2008. That means a devaluation of the dollar, which is ultimately why I think gold has made this run as a kind of signal or a canary in the gold mine in regards to that. But also is why silver is about to do what I believe it's going to do, which is go to around about $328 to begin with. Then you're likely going to see the cup and handle play out. Could see a $600+ silver price. Now, I'm interested in silver miners right now. Of course, silver also. Predominantly we're in crypto because we think it's got one of the most outrageous ROIs, but generally assets broadly are going to do well in this period. It's not just going to be gold and silver, kind of other monetary metals, you could maybe say, or value systems. Of course, it's going to be the likes of Bitcoin, which is now being pushed by Larry Fink for this exact reason. It's a hedge against one country's monetary policies. He said this on a number of occasions. We played you the clip in the last one that we did, specifically looking at Jerome Powell's timing of talking about Bretton Woods and how all of this is linked. Okay? But it's more broadly going to be assets across the board. So this is really an important video for us to make. We're making it on the back end of the speech that Christine Lagarde gave at the People's Bank of China. They are telling you what's coming. People aren't listening. And I think that's quite sad because this could have, I don't know the fashion in which all this unfolds, but this could have serious ramifications for you as an individual. And the fact of the matter is 99.9% of the world have no idea. They know something's not right, but they don't know where the problem is and potentially what it's going to lead to. And I'm here to say it's going to lead to a financial system. Cryptocurrencies are going to play a major role in enabling that new global financial system. And to take away the kind of harshness of it, perhaps, it's no different to what we've seen previously all throughout history. But I do think there are ramifications that aren't so good in regards to globalization, but that's just my own opinion. Something major is coming. Gold is signaling it. You're going to see gold continue to do really well. It's already done well, and we predicted all of that. Even though we're a crypto channel, part of what we do here and why we're unique is because we do 360 analysis. Often the answers to, or the answer that we're looking for doesn't lie specifically where we're looking for it at. It can be elsewhere, and markets are very much like that. But when there's multiple things pointing in the same direction, the devaluation of the dollar, the revaluation of the euro and potentially the pound against the dollar. I didn't show you the pound, but I could have done. The narratives or the new technological upgrade, there we go, again, the crypto is bringing to the monetary system, the debt markets, gold and silver, precious metals. I mean, it all points towards something major taking place. And it's my job, if I know there's somebody waiting around the corner for you with a baseball bat, it's my job as a decent human being to tell you that there's someone around the corner waiting for you with a baseball bat, and to not have you walk into that, because then almost I'm somewhat responsible. So that's why we're making this video. We're going to continue to do them as this all unfolds. But I truly believe something monumental's coming. And I think for me as an investor, to be quite heartless about it all, with that brings opportunities, and we're going to seize them. So on that note, guys, do check out the Patreon. There's a link for it in the description. I've not spoken to you guys in a little while. I'm enjoying the kind of lackluster market action. It can either be a blessing or a curse. I'm so confident in regards to what's coming for the crypto space that I sleep very well at night, and I don't mind when there's kind of downtime, because it gives me the opportunity to kind of get away, get out of from under the screens, and kind of think more broadly about things going on, like what this video is bringing to you. So that's it from me. Have a fantastic Friday. Enjoy your weekends. We'll be back to normal next week, guys. Thanks for watching. See you all soon.